For more reaction, let's bring in D.A. Davidson, Managing Director and Director of Research, Gil Luria. Gil, great to have you with us.
Thanks for having me.
It seems like every partnership gets applauded by the markets. I mean, NVIDIA basically hands over a check or chips to OpenAI, and that gets rewarded. Oracle gets rewarded. At what point should we actually scrutinize what this means for each company?
Right now, and you've had a great conversation so far. Let me put it together. There's real companies here, Microsoft, Amazon, Google. They have real customers. Their cost of capital is probably 5% since they have cash on hand and very low borrowing costs. They're probably getting 20% return on that. That's great. They have all the customers. They have very low cost of capital. When we start talking about these incremental players, Oracle, CoreWeave, et cetera, we're talking about companies that have to borrow at 12%, maybe 10%, and then are getting maybe mid-single digit returns. So that's like buying treasuries on margin. That is value destructive, and that's where we have to focus. And what's happened is we started with a core AI trade, which was NVIDIA and Microsoft, who have done well and captured most of the value. And the trade then expanded to these marginal players that are now trading at higher multiples. In what world should Oracle trade at a higher multiple than Microsoft when their economics are flipped? Microsoft is creating value. Oracle is going to be destroying value. In what world should Oracle trade at a higher multiple than NVIDIA? NVIDIA is going to win anyway. Everybody's going to buy NVIDIA chips. It doesn't matter who it is. Yes, they're overstimulating the market by making the deals they've made the last couple of days. But even without that, they still have the organic demand from Microsoft, Amazon, Google, Meta, Elon, et cetera. China, when they're able to sell there. It doesn't make any sense for these marginal players to trade at a higher multiple than the real companies building AI.
I'm curious then, when you get inbounds about Oracle, let's say, and Oracle, increases their CapEx, they have debt, but at every step of the way, the stock goes higher. What do you tell your clients, and what is their reaction? Do they just not want to hear it? Do they just think, you know what, this is a trade that's in front of us, and we understand that it doesn't intellectually make sense, but it is a trade?
Well, I point them to two things. One is if you go back to the transcripts from Oracle for the last few quarters, you'll see that it's not just the last deal from OpenAI that increased their backlog. It's actually been several quarters where it's really OpenAI that's been driving all of this. And then I point him to the fact that OpenAI, I think you pointed out earlier in your conversation, Microsoft still has right of first refusal on all their compute. And then they committed another 25 to CoreWeave, another 100 billion here. They're committing to building Stargate in the UK, Stargate in the Gulf. They're designing their own chips. They're building their own hardware. And by the way, they're going to lose more than $10 billion this year. Having that is the only thing that's added value to Oracle is very risky. That's not a customer that can pay all their obligations. They're double, triple booking, maybe quadruple booking capacity. They will not be able to live to those obligations. So if you're adding $400 billion of market cap to Oracle based on that, I think we should revisit the math.